of Management Studies IGNOU presents an audiobook on the course Mmpc 016 International Business Management for MBA program. Presenting Block 4 International Business Functions, Unit 11 International Finance.
Objectives. After reading this unit, you should be able to understand 1. Global financial system. 2. Basics of international monetary system. 3. Balance of payments. 4. Exchange risk management strategy and the factors affecting it. 5. Financial foreign trade. And 6. Terms of payment in international trade. Introduction. Reductions in barrier to international trade and financial flows, coupled with innovations in information and communication technology, all financial operations are becoming international as these developments has blurred the national boundaries and each financial operations, whether aimed at trading financing, investment, funding, loans, and other commercial operations, have its origin to global marketplace. Traditionally, international finance is the branch of economics that studies the dynamics of exchange rates, foreign investment, and how these affect international trade. It also studies international projects, international investments and capital flows, and trade deficits. It includes the study of future and forward contract, options, and currency swaps. Together with international trade theory, international finance is also a branch of international economics. Global financial system. First of all, we need to understand as to what is global finance. Global finance is the financial system which consists of regulators and various financial institutions that conduct their business on an international level. Therefore, in global finance, the businesses are not conducted at the national level. The primary components of global finance are the international institutions like International Monetary Fund, World Bank, and Asian Development Bank, along with various national institutions and government departments such as various central banks, finance ministries, and those private companies who act on global scale. The most prominent international institutions which are linked with global finance are 1. International Monetary Fund (IMF). The IMF is tasked with for encouraging international trade, ensuring financial stability and economic growth, and reducing global poverty. IMF oversees economic development, lending, and capacity development at global level. The International Monetary Fund also helps member states to address disequilibrium in balance of payments, grants long-term loans for financial stability, and act as a lender of last resort to avoid sovereign default. 2. World Bank. It is an institution which aims to offer funding for development projects, which for most of the part is offered to developing nations. The World Bank assumes the credit risk of these developing nations and tends to provide financing to projects that otherwise would not be able to access such funding. 3. World Trade Organization (WTO). WTO frames policies for orderly conduct of trade, commerce, and global financing. Further, it advocates rule-based and transparent policy architecture and dispute resolution procedure. WTO Agreement on Trade-Related Investment Measures (TRIMS) recognizes that certain investment measures can restrict and distort trade as some nation states can discriminate against other on the grounds of being a foreign product, quantitative restriction, and local content requiring, which has its implication for business firms on matters of global finance. International Monetary System. The IMF is primarily the set of policies, institutions, practices, regulation, and mechanism that determine the rate at which one currency is exchanged for another. The year 1252 marked the minting of the very first gold coin in Western Europe. Since then, the international monetary system has evolved and transformed into the modern system that we use today. The modern system came into existence in the beginning of the 19th century. Since then, it has crossed many stages. These are the classic gold standard, the interwar period, the Bretton Woods era, the post-Bretton Woods era or dirty float. And now let us discuss each stage in brief. The classic gold standard, 1821 to 1914. In 1821, England returned to the gold standard, and this is the period when more and more countries joined the gold standard. By 1880, most of the nations followed gold standard in one form or the other. But this was a difficult time as adhering strictly to gold standard resulted in lots of fluctuation. There were many bouts of inflation and deflation. The reason for this can be owed to high cost involved in locating, mining, and minting gold. Despite lots of difficulty, this period is considered to be the most remarkable period in the world economic history. The interwar period, 1919 to 1939. This is the period when the gold standard broke international finance down during the World War I. The gold exchange standard was reinstated for a short period from 1925 to 31. In this period, only USA and England could keep gold reserves, and other nations could keep both gold and dollars or pounds as reserves. In 1931, England departed from gold standard. The Bretton Woods era, 1944 to 71. In 1944, a conference was held in Bretton Woods, New Hampshire, to chart out a new post-war monetary system. Two new institutions, namely International Monetary Fund (IMF) and the International Bank for Reconstruction and Development (World Bank), were created to implement the new system. Under this system, each country pledged to maintain a fixed or pegged exchange rate for its currency with dollars or gold. 1 ounce of gold was equivalent to $35. The fixed exchange rates were maintained by official intervention in the foreign exchange markets. The fixed exchange rate received a great deal of uncertainty from international trade and investment transaction. This system collapsed with the dissolution of the gold standard. The reason for the collapse were due to A. Inflation in US, B. Vietnam War in mid-60s, C. Major countries like West Germany, Japan and Switzerland refused to accept economic cost associated with inflationary pressure of US dollar depreciation. The above reasons resulted in sharp depreciation of dollar, resulting in collapse of Bretton Woods system. The post-Bretton Woods era or dirty float, 1971 to present. The world officially shifted to floating exchange rate in 1971 when dollar was devalued to 1/38 of an ounce of gold. Post-1971 saw many events happening on the international economic front. These are OPEC and oil crisis, US dollar crisis, rising dollar, sinking dollar, Asian financial crisis, subprime crisis, Eurozone crisis, COVID-19 pandemic and re-globalization debate. At the moment, the international arena is witnessing lots of change with trade and tariff wars, pandemic-induced economic shocks, and technological advancements. IMF and other financial institutions are on tours to manage the international monetary system. International flow of funds. COVID-19 pandemic has brought the global economic system to stand still, affecting economic activities, international trade, and movement of capital and labor, which affected adversely the international flows of fund. After witnessing a contraction in 2020, world trade is rebounding and has surpassed the pre-pandemic level, touching to historic level of almost $22 trillion, but regional challenges remain. According to WTO, global merchandise trade volume growth is more than 10.5% in 2021. Even with rebounding of international trade, the financial challenges remain for many vulnerable states across the world. These include loss of service trade, ever-increasing national debts, depreciation of currencies, loss of national income, quantitative easing and exchange rate instability. These challenges are intertwined and interlinked, causing problems of orderly flow of international funds, thus resulting in economic woes to many nation states in the world. Let us now discuss one of the major parts of international flow of funds, that is, balance of payments. Now the question arises, what is BOPs? Balance of payments, BOPs, is an accounting statement that summarizes all the economic transaction between the residents of the home country to that of residents of all other countries. The balance of payments is the economic barometer which the countries use to monitor all international monetary transactions at a specific period of time. Usually, the BOPs is calculated every quarter and every calendar year. All the transactions, both by the private and public sectors, are accounted for in the BOPs so as to determine the amount of money coming in and going out of a country. If a country has received money, this is accounted as credit, and if a country has paid or given money, the transaction is accounted as a debit. Conceptually, the BOPs should be zero, meaning that assets and liabilities should balance, but practically this is a rare. Thus, the BOPs can tell the observer if a country has a deficit or a surplus and from which part of the BOPs account the discrepancies arise. Categories of balance of payment. The BOPs has four main categories. 1. Trade account, which records the flow of merchandised goods. 2. Current account, which records the flows of services, remittances, and other invisible transfers. 3. Capital account, which shows public and private investment and lending and borrowing activities. 4. Financial or official reserve account, which measures changes in holdings of gold, special drawing rights, and foreign currencies, that is, resource assets by official monetary institution. Foreign exchange market. Since World War II, the international transactions have grown to a large extent. This has resulted in the growth of foreign exchange market. The foreign exchange market is a market where the foreign currencies are traded. The primary functions of a foreign exchange market are to facilitate international trade and investments. There are two types of important market under foreign exchange market. 1. Spot market, where currencies are traded for immediate delivery, and 2. Forward market, where currencies are traded for future delivery. Need of foreign exchange market. This market is required because there is no single international currency. Therefore, the main aim of such kind of market is to facilitate the exchange and trading of one currency with another. For example, an Indian exporter sells pharmaceutics to US-based importer for US dollars, which has to be exchanged in equivalent INR, and similarly, when a Kenyan importer buys automobiles from the US-based supplier, he or she has to convert equivalent Kenyan shilling into US dollar to pay. Each country of world does not have hard currency, that is freely convertible currency. As a result, most of such kind of exchange transaction occurs through worldwide internet banking. Interbank market. This market is known as the foreign exchange market. Basically, this market is an over-the-counter market, that is, it is not a physical place but exists everywhere and functions round the clock, days and nights, anywhere around the world. Usually, the currencies traded in foreign exchange markets are hard, stable, and convertible currencies. The major players who participate in the foreign exchange markets are the large commercial banks, individual firms, governments, and sometimes the international agencies. These are two tiers in the foreign exchange market, and these are Tier 1, transactions between ultimate customer and the bank. Tier 2, transaction between banks. Transactions in the internet market. Transactions in the foreign exchange markets can be executed on a spot, forward, or swap basis. Spot transaction. A spot transaction requires almost immediate delivery of foreign exchange. In the interbank market, a spot transaction involves the purchase of foreign exchange with delivery and payment between banks to take place normally on the second day following the business day, also known as T+2 settlement date. The date of settlement is referred to as the value date. Spot transactions are the most important single type of transaction and constitute around 45% of all transactions. Outright forward transactions. A forward transaction requires delivery at a future value date of a specified amount of one currency for a specified amount of another currency. The exchange rate to prevail at the value date is established at the time of the agreement, but payment and delivery are not required until maturity. Forward exchange rates are normally quoted for value dates of 1, 2, 3, 6, and 12 months. Actual contracts can also be arranged for lengths. Outright forward transactions only account for about 9% of all foreign exchange transactions. Swap transactions. A swap transaction involves the simultaneous purchase and sale of a given amount of foreign exchange for two different value dates. The most common type of swap is a spot against forward, where the dealer buys a currency in the spot market and simultaneously sells the same amount back in the forward market. Since this agreement is executed as a single transaction, the dealer incurs no unexpected foreign exchange risk. Swap transactions account for about 46% of all foreign exchange transactions. Foreign exchange rates and quotations. A foreign exchange rate is the price of a foreign currency. A foreign exchange quotation or quote is a statement of willingness to buy or sell a currency at an unannounced rate. Bid and ask quotations. Interbank quotations are given as bid and ask. A bid is the exchange rate in one currency at which a dealer will buy another currency, and ask is the exchange rate at which a dealer will sell the other currency. Dealers buy at the bid price and sell at the ask price, profiting from a spread or difference between the bid and ask prices, concluding that bid is smaller than ask. Bid and ask quotations are complicated by the fact that the bid for one currency is the ask for another currency. Simply putting it, a forex dealer buys currency at bid price and sell them at ask price. Foreign exchange derivatives market. They do not have worth of their own and derive their value from claim they give to their owners to own some other financial assets or securities. For instance, one takes an insurance against his or her house covering all risks. This insurance is also a derivative instrument on the house. Major derivatives are A. Forward contract. A forward contract is an agreement between two parties to buy or sell an asset at a specified point of time in the future. In case of a forward contract, the price which is paid or received by the parties is decided at the time of entering into the contract. It is the simplest form of derivative contract and is mostly entered by individuals in their day-to-day life. Forward contract is a cash market transaction in which delivery of the instrument is deferred until the contract has been made. B. Futures contract. Futures is a standardized forward contract to buy or sell the underlying asset at a specified price and at a specified future date through a specified exchange. Futures contracts are traded on exchanges that work as a buyer or seller for the counterparty. Exchange sets the standardized conditions in terms of quality, quantity, price quotation, date and delivery place. C. Options contract. In case of future contract, both parties are under obligation to perform their respective obligations out of a contract. But in an options contract, as the name suggests, is in some sense an optional contract. An option is the right but not the obligation to buy or sell something at a stated date and at a stated price. A call option gives one the right to buy, a put option gives the right to sell. D. Swaps contract. A swap can be defined as a barter or exchange. It is a contract whereby parties agree to exchange obligations that each of them have under their respective underlying contracts, or we can say a swap is an agreement between two or more parties to exchange stream of cash flows over a period of time in the future. The parties that agree to swap are known as counterparties. Exchange risk management strategy. The values of major currencies keep on changing every second, thus creating income uncertainty for international trade and investment decisions. The firms engaged in international trade and financial transactions plan to eliminate this uncertainty by locking in future exchange rates. In this context, the foreign exchange risk management strategy helps manage currency risks, including anticipated fluctuations in future. Hence, the risk management strategy is based on a set of procedures involving business specifics, including environmental assessment, the location of its competitors, degree of cash flow visibility, its pricing parameters, decision criteria vis-a-vis risk and reward tolerance, familiarity with different risk management styles, and the weight of a currency in foreign exchange market. Companies involved in international trade and financial transactions should know various types of exchange risk exposures and different type of hedging instrument and techniques available to them for covering of risks. Hedging instruments are aimed at offsetting the losses in international financial transactions and investments by taking an opposite position in a related asset. Hedging instruments typically involve derivatives such as options and future contracts. Commonly used hedging strategies are divided into 1. Full hedging, 2. Selective hedging, and 3. Casual approach to hedging. Exchange risk management strategies will vary from organization to organization. The international finance strategy depends upon the risk appreciation attitude of the organization, nature of exposure, significance of the risk on profitability, and resources available to the organization. With experience and knowledge of exchange rate system, an organization can profit through exchange risk management. In the pandemic-induced volatile and ambiguous times, more and more exporters and importers are having internal expertise in understanding exchange rates movement on the basis of macroeconomic fundamental and accordingly leverage hedging instruments to maintain and earn profits. Foreign investment. Foreign investment in its classic definition is defined as a company from one country making a physical investment into building a factory in another country. In an era of globalization, foreign investment's definition has been broadened to include the acquisition of a lasting management interest in a company or enterprise outside the investing firm's home country. As such, foreign investment in another country or foreign firm may take many forms, such as a direct acquisition or purchase of a foreign firm, completely new construction of a facility in form of greenfield investments, or investment in a joint venture with foreign firm. Furthermore, foreign investment may also be in a form of strategic alliance with a foreign firm with attendant input of technology or technical know-how, licensing of intellectual property, or entering into management contract or turnkey projects. Foreign investment primarily may be of two types, that is, foreign direct investment (FDI) and foreign portfolio investment (FPI), which in turn may have several subconstituents. Foreign direct investment is an investment by foreign investors into the assets of host country structures, real estate, roads, ports, rail, plants and machinery, equipment, financial institutions such as opening a new bank or insurance company, and sometimes in host country organizations like investment in Indian Premier League (IPL) by foreign countries. Foreign direct investment does not include foreign investment into the stock markets of host countries, that is, separately treated as portfolio investment. In other words, the term portfolio refers to any collection of financial assets such as stocks, bond, and cash. Portfolio may be held by individual investors or managed by financial professionals, hedge funds, banks, and other financial institutions. Advantages of FDI. When direct investment tends to flow from one country to another, it presents benefits both to the home country as well as the host country, but at the same time involves some costs also. Let us see some of the advantages of the FDI to the home as well as the host countries. The advantages to the host country are A. Availability of scarce factor, that is capital. B. Improvement in BOPs. C. Building of economic and social infrastructure. D. Fostering of economic linkages. E. Strengthening of government budget. The advantages to the home country are A. Supply of required raw material. B. Improvement in BOPs through dividend, royalty, etc. C. Enhanced employment opportunities. D. Develops closer diplomatic ties between two nations. These advantages, although, are conditional depending on the linkage of home as well as the host country. Terms of payment in international trade. Most of the MNCs, along with even the small-sized exporting firms, are extensively involved in foreign trade apart from the other international activities. This section highlights different modes of payment in international trade. In highly competitive international markets today, the nature of payment terms offered is often play a decisive role in obtaining export orders. One has to be very careful and selective in negotiating the payment terms for a particular business. This decision is affected by various factors which can be categorized as 1. Nature of goods, 2. Size and amount of the transaction, 3. Credit worthiness of the buyer, 4. Economic and political situation of the country of exports, 5. Export or import policy and exchange control regulation of importing and exporting countries, 6. Credit or payment terms offered by competitors, 7. Financial strength of the exporter. Payment terms should be offered or accepted for trade transactions only after a careful analysis of these factors. Let us now discuss different payment terms which are used for settlement of payments in the international trade. 1. Payment in advance. Payment in advance is the safest method of payments. An exporter realizes the export proceeds in advance from an importer before the actual dispatch of goods. Payment in advance is extremely favorable to an exporter and is the most risky for any importer. In actual business practice, there are rare examples of payment in advance. However, part payments in advance are common. 2. Documentary collections. Documentary collection is one of the most preferred methods of payment settlement in international trade. It balances the risks exposure between both the trading parties. Under this method, an exporter manufactures or procures goods and dispatches them to an importer through agreed mode of transport, delivery terms, and cargo insurance policy. Exporter prepares the document and submits them to his bank as per procedure as laid down under Foreign Exchange Management Act 2000 and regulations therein. Remitting bank process the documents to collecting bank, which asks for collection of payment from importer against trade documents. Documentary collections are of two types, namely documents against payment (DP), also known as sight draft or sight bill. Under DP transaction, an importer pays to the collecting bank before collecting the trade documents. Second type of documentary collections are known as documents against acceptance (DA), also known as time draft or bill or usance draft or bill. There is credit period extended by exporter to importer under DA transactions. DA transactions are risky and should be used with due diligence. 3. Open account. Open account is most risky method of payment for an exporter and most safe for an importer. It is just opposite of payment in advance. Hence, it is extremely favorable to an importer and extremely risky to an exporter. Under this method, exporter negotiates and signs an export contract and ships the goods to an importer. Exporters also dispatch the trade documents, evidencing the transfer of ownership from an exporter to an importer. This method of payment is used in cases of extreme trust between two trading parties, established trade relationship, and sister concerns or subsidiary firms. 4. Letter of credit. Letter of credit is widely used in high-value business transactions. It is considered a safe payment term. Exporters prefer LC terms in case of long-duration business deals, doubt on importer credit worthiness, or lower credit rating, new and unestablished business relationships, countries with high political or economic risks, etc. Under a letter of credit, an importer asks his or her bank to make a contractual agreement with beneficiary for supply of agreed goods and services. As a result, the risk of payment passes from an importer to bank. Bank undertakes a negotiable commitment for payment to an exporter subject to documentary compliance. Issuing bank issues a contractual agreement in favor of beneficiary through swift message at exporter bank, which is called an advising bank. Advising bank advises to exporter on various terms and conditions of credit and other associated risks. After dispatch of cargo, an exporter is required to submit trade documents to the bank as per negotiated terms and conditions of LC. The negotiating bank routes the documents to issuing bank under established banking customs and procedures. Issuing bank pays subject to fulfillment of documentary compliance. To successfully leverage LC as payment mode, Trading parties should be aware of process, parties involved, and papers, which is exhibited step by step. Documentary credit transactions are guided by a set of customs and practices published by the International Chamber of Commerce, Paris in 1993, under revised publication number 600 and titled as Uniform Customs and Practices for Documentary Credit, UCPDC. UCPDC defines letter of credit, explains, clarifies various situations and doubts, roles of different parties involved, and documents required. Hence, it is very important to know and refer UCPDC while transacting under documentary credits. Following are the main parties who are generally involved in such transaction. 1. Buyer, applicant or importer. 2. Issuing bank. 3. Advising bank. 4. Confirming bank. 5. Negotiating bank. 6. Reimbursing bank. 7. Seller or beneficiary or exporter. Different types of letter of credit are described as their salient features, uses and risks for both parties to trade transaction, that is exporter and importer. Summary. Global finance is a financial system which consists of regulators and various financial institutions that conduct their business on an international level. Therefore, in global finance, the businesses are not conducted at the national level. The primary components of global finance are the international institutions like International Monetary Fund, World Bank, and Asian Development Bank, along with various national institutions. Exchange risk management strategy depends upon a company's attitude towards risk and reward or profit motivation. There could be 4 possibilities: low risk and low reward, high risk and low reward, high risk and reasonable reward, and high risk and high reward. For covering exchange risks, a company has to develop a basic hedging approach, which could either be full hedging, selective hedging, or casual hedging. The technique of risk management grid based on exchange rate trends of the currencies can help a company in maximizing its profit. There are several factors that influence strategy on exchange risk management, and the main factors include type and size of exposure, stability of currencies, maturity period, ability to forecast exposure, treasury management expertise available with the firm, access to hedging instruments, etc. Mode of payments is used to settle payments in international trade transactions. Each payment is unique and has advantages associated with either party of trade, that is, exporter and importer. There are 5 payment terms used in international trade. These are payment in advance, open account, documents against payment, documents against acceptance, and letter of credit.
You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code Mmpc 016 International Business Management. Course Coordinator Professor G. Subayama. Voiceover by Renuka. Edited by Ashok Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.